The ECB announced a number of measures. Essentially, they cut interest rates so that deposit interest rates with the ECB became more negative. They cut the refi rate to only 0.05%, and they announced a firm commitment to purchase asset-backed securities outright, and said that they would give us the full details of those asset-backed purchases in October. So, turning in a bit more detail to the interest rate changes, the driver for that really was the weakening in inflation expectations for Europe. That's what the ECB were reacting to. They were concerned that long-term inflation expectations were becoming unhinged, so they wanted to take action quicker than the market had expected to try and achieve their objectives. In cutting interest rates, that means that banks will now be able to borrow from the ECB for up to 4 years at only 0.15%. So very attractive lending rates from the ECB and a lot of liquidity coming to the market. To be very powerful though, they additionally have said that they're going to do outright purchases of asset-backed securities. As I said, we haven't got the final details of that yet, but in October we're going to get those, and we would expect this would allow the ECB to purchase bonds in such a way that it gets the capital risk of those bonds off the bank's balance sheet. Their aim here is to allow banks to be able to start lending again, because it will obviously mean that they've got more capital to actually put to fresh loans if they're handing over their existing obligations to the ECB. Now, what are the implications for the markets of this within Europe? Obviously positive for the ABS market. The ECB had been talking about this since the early summer, and for our portfolios we've been increasing our allocation to ABS, expecting this announcement to come through and to be positive, not necessarily expecting it as early as this month, but wanting to be that way positioned. We think there's further to go in those securities, and we are still seeing value in the asset-backed market in Europe. We also think there's implications for financials, because the banks will be able to borrow money from the ECB at such attractive levels. They're going to be less likely to come and borrow money from the market, and it will also improve their profitability. So we continue with the theme that financials should do well within the European market, both on a supply and a fundamental basis. We've had exposure to the peripheral European bond markets, so the markets of Italy and Spain, and they've been doing really well recently. Again, we think there's probably some further room for those bonds to outperform, but we have to be cognizant that they've come a long way. What we've been doing within the portfolio is saying, rather than owning the traditional nominal bonds issued by Spain and Italy, actually with the ECB's reaction function to inflation expectations now so clearly delineated, moving that allocation into inflation-linked bonds, so that if those expectations deteriorate further, we would expect the ECB to come back again and provide more stimulus, and that to be further supportive for those peripheral European bonds. So plenty from the ECB to be encouraged about. Far from certain that it will ultimately be successful, but plenty to be encouraged about, and actually plenty to, as a bond investor, to take their actions and say, well, these are constructive things we can do in portfolios to take advantage of it.
The contrast with Europe couldn't be more stark, to be honest. We sit here today with growth in the US having bounced back in Q2 at a 4% plus pace. Q3 growth looks like it's shaping up to be a 3% plus type number. We have to keep in mind that inflation, whilst in the last month or two hasn't been that robust, we have lifted comfortably from the lows that the Fed were worried about only 6 months ago. And the employment dynamics as well have continued to develop in line or better than most Fed members had expected, again, only 3 to 6 months ago. So the surprises across the board on the US growth and employment dynamics have been robust and solid and seem to be continuing at a fairly robust pace. In that context, it's not surprising that recently we have heard a little more balanced rhetoric from Janet Yellen, the governor of the Fed, who historically has been very, very dovish with regard to US monetary policy. And at the same time, we've also had increasing disquiet from some hawkish members of the FOMC who are becoming increasingly uncomfortable, not with just the level of US monetary policy, but also the seeming endless commitment from the Fed to provide ongoing stimulus in what is clearly a much better growth dynamic in the US than they expected at the beginning of the year. Having said all of that, what it really is surprising from our perspective is the recent performance of the US bond market, which has clearly delivered some very positive returns year to date in an environment where we would have expected and continue to expect quite the opposite. So given what the US bond market has done to date, we do not necessarily believe that this is a precursor to ongoing and continued performance of this nature. We think it is certainly surprising, but certainly not indicative of an ongoing trend. And as you will know from previous commentaries and discussions, we are very, very light on US interest rate risk within our portfolios. We have very, very little exposure to the US market. And in actual fact, we kind of believe that if our story and if US interest rates ever begin to rise or reflect the growth concerns that we believe are there, portfolios should perform quite well in this environment, given our limited interest rate exposure in the portfolio. As you've heard from Phil, where we do hold our interest rate exposure is in Europe, where we are getting many more signals that asset prices and fixed income prices are pretty well supported. So clearly this policy divergence issue and economic divergence issue that you've heard plenty from us on before is something that is very well reflected in the portfolio. Not only is it reflected in interest rate space, it's also reflected in currency space, where we have had a long position to the dollar for quite some time. Despite the fact that it was pretty slow to get moving at the beginning of the year, it has now begun to find its feet and is moving higher in a meaningful fashion, particularly versus the euro, given recent developments from the ECB. We think this is something that is set to continue, and we fully expect the dollar to continue its recent upward momentum into the end of the year. We are still long, and we are also long versus the Japanese yen and some other currencies as well.